This webinar is proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.
Thank you, Simon. Guys, today we're going to have a look at triangles. They are consolidation patterns. There's some basic rules to get started with. Price has a narrowing or widening formation where two trend lines form a triangle type pattern. Each trend line has at least two touches and there are distinct peaks and troughs. The trend lines are drawn on the first two peaks and the first two troughs, and they are then extended into the future, and then we wait for price action to tell us what to do. The prior trend has little relevance, the breakout direction being more important. If you go back a few years, let's say 5, 6, 7 years ago, triangles were considered continuation patterns. These days, with the advent of automatic trading, computer trading, algorithms and so on, the direction of the breakout has become more important than the old probabilities. The triangles should form over periods longer than 3 weeks, otherwise they'd be called pennants. The first one we're going to look at here is a symmetrical triangle. It has a downward sloping upper trend line and it has an upward sloping lower trend line. We can see the first two touches over there, and we can see the distinct troughs at the bottom here, and we can see very clearly that the market has swings. The trend line is then extended into the future and price moves towards the apex of the triangle. One point to note, an increasing volume on the breakout, we can see in the bottom right hand corner, volume is increasing while price is breaking outside of the triangle pattern, which is on the red rectangle. And this is nice to see, but it is not required. The trade setup and result, we can see the symmetrical triangle got broken. We had the increase in volume. Excuse me. The entry is on a break above the trend line, and the stop loss is a close below the lower trend line. So we would have a stop loss automatically trailing as that trend line goes into the future. The price breaks out and starts moving. The target is the distance from the widest point of the triangle. Here it would be the red and blue dashed lines, and then that would be extended into the future, depicted by the green dashed line and the green circle. And in this example, excuse me, Implats went straight through to the target without hesitation and no real pullbacks. The second pattern we're going to have a look at is called descending and ascending triangles. A descending pattern means that the lows are horizontal, in other words, you have a support line, and the highs are declining, so we have lower highs into the apex. An ascending pattern means the highs are even, so we have resistance that is horizontal, and the lows are rising, in other words, rising bottoms. Then something that's very seldom spoken about is the busted ascending or descending triangle pattern, and this is actually more common than the perfect setup, and I thought today we'd have a look at an example of that. Here we have the busted triangle. The rules of the triangle still remain relevant. We have two upper touches. The trend line is then extended into the future. We have two horizontal support areas, and that trend line is also extended into the future. We can see distinct peaks and troughs. The difference, though, from a normal triangle is this particular pattern broke through the lower support line, probably sent us short on the breakout, but it didn't go lower than 10% of the price from the breakout. It then pulled back into the triangle pattern and broke the upper boundary. We then consider it busted, and we would have exited the short. So entry number 1 would have been short on the lower red circle once it broke the support line. The stop loss would have been the downward sloping trend line. We stopped out, and then entry 2 kicked in, and we would have gone long on that break and close above the sloping trend line. The stop loss would then become a close below the lower support line. The target for either trade would have been the maximum distance created by the triangle pattern. And we can see again extended into the future by the green dashed line and the green circle, and we can see Woolies went exactly to that target level, broke slightly higher, then pulled back. Please note that these chart patterns are target based, so they have nothing to do with trend or any such thing. Once it hits its target, take the profit and walk away. We'll discuss some alternative stop losses going forward. Should the price move below support for a second time, we can see depicted by the red lines and the red circle, then the long trade would have been stopped out. The pattern can then be left alone and considered finished for our purposes. There are, however, double and triple busted triangles. In other words, this pattern can do this 2 or 3 or 4 times even. But for trading purposes, I would prefer to just have 2 goes at it. The third pattern we're going to look at are called broadening patterns. Basically, price starts off in a tight range, so in the apex of the triangle, and then broadens over time to higher highs and lower lows. The first 2 points are identified and the trend lines are extended into the future. In other words, the triangle rules remain the same. The breakout direction determines the trade again. A partial drop before an upward break or a partial rise before a lower break can give confirmation. It is, however, difficult to use those partial moves as an early entry point, as we'll see in the next slide here. Alright, broadening symmetrical triangle. We have higher highs depicted by the green triangles. We have lower lows depicted by the red arrows. Price is broadening. We can see a partial rise over here, which would only identify once price broke the lower trend line. Entry can be executed on a break above or below the relevant trend line. A stop loss can be executed should price move back into the pattern. So let's say, we entered over here, price moves back in, we would stop out. Due to the nature of the price range widening, in other words, the market has quite a bit of momentum by the time it breaks the pattern, the target is reduced to 62% of the widest point, again depicted by the red dashed lines. It broke lower, we then put 61.8% extension on that distance, and that would be the target. Again, the green circle and the green dashed line. Target based is 5 and a bit percent in this particular trade. So you might want to avoid it if your risk reward ratio is too high. It was quite a deep breakout, but the pattern works really well if I only use a 62% target. Alright, to wrap up, the rankings that you saw in the previous slides are based on 23 different chart patterns and are calculated on the absolute targets being reached. In other words, the width of that triangle is reached however many times. If it doesn't reach that before reversing, then the pattern is considered failed. Now, those of you that have heard me before, watch some of the webinars I've done, it's much simpler to trail your stop behind the price move than it is to trade just with target or a baseline stop loss. So I have found trailing stops to be a good way of locking in profits before targets are reached, using a previous swing high or low, or even as tight as the previous candle low as a stop area. This can lock in winners that would often have become losers if you had waited for the target to be hit. There are 10 different triangle formations that can be studied. From wedges, symmetrical triangles, we've had a look at the descending triangle, you get ascending triangles. There's plenty to go and have a look at. The rules remain the same for each pattern, apart from wedges. Each of the 3 patterns have opposite breakout potential, which leaves the prior trend almost irrelevant. So all 10 of those different triangles have the same basic idea. They are consolidations, the direction of the breakout being more important. Each chart pattern has a busted or a number of bust versions. So even on the descending triangle, that could have been busted. Ascending triangles can be busted, symmetrical triangles can be busted. 2 busts, and we then leave it alone for leveraged trading. If you are seriously interested in chart patterns, I would certainly recommend the Encyclopedia of Chart Patterns by Thomas Bulkowski, and he's really gone in detail to all the probabilities, target, how often they reach it, and he's ranked each pattern based on bullish and bearish versions. Thank you for listening to me today. You're welcome to contact me on 0741737358 or email me warren@thetradersplace.co.za, and of course you're welcome to go and have a look at my website www.thetradersplace.co.za. Thank you.
This webinar was proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.